very happy, okay, and honored to be able to partner with Nimbus Capital to actually host this investment webinar with us. So Nimbus Capital is actually founded by Mr. Ted Zhao. So he is a trading coach, founder and director of Nimbus Capital Solution. He has more than 8 years of experience in this investment field. And one thing I like personally about Nimbus Capital Solution is that the solutions provided are something that is very heartfelt, just like our values, by the people, for the people. Mr. Ted's advice is all through his own experiences. So he will use proven and time-tested investment style and strategies to help his clients build the right equity portfolio, okay, based on be it short-term or long-term financial goals. All right. So without further ado, I'll give the time to Mr. Ted to actually start this investment webinar proper.
Thank you, Elvin. Hello, everyone. So I'm Zor from Nimbus Capital, and it is an honor here to be presenting today as well. So for today, right, we are going to demystify what is investing and how can you actually get started. So investing is like a magical word that everyone seems to be doing right now. It's like, hey, I'm doing investing, or you might know a few of your friends who are into investing as well. So it is something that everyone seems to be doing, but maybe it's hard to pinpoint what exactly investing is. And in fact, it is good to see more and more people are taking interest in investing, because if you might have noticed, right, for the past 5 years, investing has been made very easily accessible to the general population. It is no longer a thing that is only available to all the rich folks. So for today, right, we are going to sort of guide you through how to start this investment journey. So what is investment? The technical definition is that it is a buying of an item or an asset with the goal of generating income or appreciation. So appreciation here means we are talking about capital appreciation. It's not like you go and buy a PS5 and then you appreciate by playing games on it. So we are not talking about those kind of appreciation. And as an example, right, property is one form of investment that fall into both categories. You can generate income by renting out, and at the same time, right, the value of your property also appreciate over the years. And this is one of the reasons why property has been the mainstay investment vehicle. Or maybe when you were young, right, you might also be an investor by an accident, because that Charizard card that you got from your $5 booster pack is probably worth like $10,000 right now. So that is also like an accidental form of investment. So now that we are working adult already, right, driving to a shop to buy like 1,000 pack of Pokemon cards might not be a great idea to start investment. So what are the kind of items and assets that we are supposed to acquire to build up our investment portfolio? Do you simply just walk into the bank and go and tell the counter, hey, one investment, please? So the counter will be probably like lost. So when we think about this, right, saying things like one investment, please is equivalent to like walking into a restaurant and say, I want food, because if you say you want food, right, it depends on what you are looking out for. Do you want a light meal? Do you want a fast food? What kind of cuisine you prefer? You want veggie, meat, rice, noodle, dessert? Do you want spicy stuff? So food actually caters to a lot of different needs, different tastes. And same thing with investment, right? Even though there are many investment vehicles out there, each investment vehicle actually cater to certain needs on the investor, certain, I would say, a preference of the investor itself. So imagine that if you are a 80-year-old millionaire who just want a constant stream of passive income without risking anything, right? The kind of investment vehicle you choose will be different from, say, someone who just graduated and just got their first job. So there are a few major factors that will determine what kind of investment product that you should choose. And these are the factors that we will go through. So firstly, we have gone through what is the need. So for whatever investment that you are, the product that you are trying to choose, right, it must meet your need. So at the present, currently right now, when we talk about need, when referring to investment, right? Most likely what you will feel is, as long as I get profit can already lah, as long as I earn more than what I put in, that's my need lah. But in fact, as we go through the later slide, you will find that need is something more, it's not so simple lah, it's not so simple. The second criteria is time. So this time is, I'm referring to the time that you have available for investing, the time in the market. So imagine that you are 30-year-old. So meaning you probably have about 50 to 60 years of investment time for all your investment product. You have huge amount of time you have at hand compared to, let's say you are at 70 years old, right? Then you probably do not have much time to invest really lah. So your time in the market is a very crucial factor. And the next item is risk. So this risk is referring to how much risk that you can take on. And this is proportional to time also, because for example, let's say you are 20 years old, and within your 20 years to 30 years, right, you don't really know what you are doing, you anyhow invest, or maybe you didn't even invest at all. So if you make this kind of mistake, right, because you are young, it is very easy to recover from this mistake because you still have another 50 to 60 years of investment time. And because you are also still working, right, you still have that income from your salary to sort of made up for any investment mistake that you have made. But imagine you are in that same situation at 70 years old, right? You can't really afford that level of risk really because it's hard to recover from. So risk and time, remember that they are proportional. The more time you have, the more risk you can take. And finally, of course, your financial situation. So this is referring to, of course, how much disposable cash that you have available to invest, or your salary, your earning power. So with all these factors combined, right, we can come up with three major profiles. So these are the profiles that we have. The first one is, of course, student, young working adults. So for this group, right, you probably just started working, just have your first job, your salary just come in. So your capital is pretty low, but because you are young, right, you are able to take on risk and you have a lot of time on your hand. And the second profile will be the working adults or working parent. So this is somewhere in the middle, it is like balance, but you probably have your mortgage to pay, you have your kids to take care of. So your risk, not so much really. The time in the market also like somewhere in the middle. But since you have several years of working experience, your salary probably have grown, so you have slightly more capital compared to the student profile. And lastly, we have the retiree. So these are folks that are no longer in the workforce, going to or already retire, a lot of capital, a lot of savings. But unlike the young student working adults, right, you don't really have the luxury of taking on risk or time because your time in the market is not so much really. Of course, we also have other small niche profiles such as trust fund baby, or maybe your like relative is the CEO of Hai Di Lao and give you big ang pao, that kind of thing. But we won't go through all these niche profile. We just go through these three major profile. So given the profile that we mentioned, right, we'll be covering only one investment vehicle today because this specific product, right, it is able to meet the needs of all three profiles, and it is very versatile. And that investment product we are going to be going through is unit trust. So in order to explain what unit trust is, right, first consider this scenario. I'm sure you all have heard of FANG stock, the 5 prominent American technology company. So Facebook now is known as Meta, and Amazon, Apple, Netflix, and Google. So these are the FANG stock. But because Facebook have changed its name, right, I like to call it manga. It's no longer FANG, okay. So if you still prefer FANG, you can blame Mark Zuckerberg. So imagine that you want to start investing today and you just want to buy one share of each of these companies, and how much capital is it going to take? So based on the time that I make this presentation, right, Meta is at US $348 per share, one share. Apple is at US $151, Netflix is at $645, Google is at 2,984 is quite expensive. And of course, Amazon even worse, 3,518. I think this presentation was made like 1 month ago. The price probably changed now, but still, if you combine all these together, right? If you buy one share of each of this capital, it is going to cost you a total of US $7,646, which come about Singapore $10,000. It's not a small amount, especially if you are someone who just started working. So the disadvantage of doing this approach is, first, it is very expensive to get started. And secondly, right, if you are buying 5 companies like that individually, you are going to incur 5 times transaction fees. And in fact, currently the brokerage fee is kind of expensive, I would say. And of course, even for $10,000, right, you are only investing into 5 companies, and this is not enough diversification. So it doesn't really make sense for you to buy individual shares of the companies. So that is where unit trust is very useful, because it invests a pool of money from like-minded investors like yourself, right? So there will be a fund manager that will take the pool of money from all the investors. And then this pool of money is actually quite a big amount. If you look at any unit trust fact sheet, right? Every unit trust, they comes up to about maybe 10 mil, or some can go up to 500 mil of investment fund put together. And with all this money, right, the fund manager will actually buy up all the so-called company that he feels have potential and have growth. And after he buy up everything, right, he will sort of sell this entire fund as a unit trust. Or for example, in this case, right, they can sell it at this, they can sell all these companies as US Tech unit trust. So the theme here is US technology, where you not only you have all the FANG or the manga company here, right? There are also many more. So typically a unit trust tend to have like maybe 50 to hundreds of companies there. So it's very well diversified. And if you want to buy one unit of such unit trust, right, it is relatively cheap, about Singapore $106. So this is just some random unit trust that I pull up from the internet. So this is just to show you how much one unit trust costs, which is SGT $106. That compared to the $10,000 that we see just now, if you want to buy each company separately, right? This is the barrier for entry is not so great lah. So it is much more preferable. So now that you somewhat know what unit trust is, right? So once again, do you just walk into a bank and say 1 unit trust, please? So not really, also because it has it's no different from saying 1 investment, because even within the scope of unit trust, right, the umbrella of unit trust, there are many kind of unit trust to fit your different needs. And today, right, with respect to the 3 profile that I have just mentioned, I'm going to specifically pick out certain unit trust theme, certain category that I feel are very good for your investment journey lah. And one of the theme that I want to talk about is growth. So as I'm going through all the pros and cons of all these teams, right, I want you guys to sort of reflect back to the profile that I mentioned earlier, and you will see how it starts to click together lah. So for a growth company, right, these are companies that anticipate to grow at a much higher significant rate compared to the market. So they are focusing on growth lah. And the pros of this is they have high capital appreciation. And the cons is that since they are growing, it take time to grow. So it's like growing a tree lah. So right now, right, I underline and bold that takes time to grow, because in order to benefit from growth team unit trust, you need time. And another con is that growth unit trust does not give out dividend, mainly because they want to ensure that all the profit they make, right, they can put back into the company to grow furthermore lah, since that's their focus. So one example of growth company are things like Nvidia and Amazon. So if you want a growth unit trust, right, you should look out for unit trusts that contain these kind of company. So as an example, right, if you compare Amazon to the S&P 500 within that same time frame, you can see how much Amazon have grown compared to the benchmark market lah. So the next theme is D&D, not Dungeons and Dragons. So it's defensive and dividend unit trust. So these are companies that tends to remain stable, slightly lower risk, and they are quite stable throughout all phases of economic cycle. So one way to look at it is to go and find during this COVID-19 back in 2020, right? You go and find which are the companies that like manage to remain stable and they tend to pay out their earning as dividend to you, so you can earn passive income from these companies. So the pro is that price remains stable during economic uncertainties, and they provide consistent stream of passive income. And time is not required to reap the dividend benefit, meaning let's say you have $100,000 right now, you can simply put in the $100,000 into a D&D unit trust and you will immediately gain that dividend benefit. And the con is that there is not much capital appreciation compared to growth, and large capital is required for your passive income to be substantial. So let's say you are a student, right? And you only have $10,000 in saving, and then you invest that $10,000 into a dividend and defensive unit trust. Maybe that unit trust give you 5% dividend every year, but since you only have $10,000, right, you only get back like $500 dividend per year, and that's not the kind of return that you want. So if you have low capital size, right, then these are the kind of unit trust that maybe you might want to avoid. So some example of defensive company are Coca-Cola, Sheng Siong, and Philip Morris. So if we compare back to the same S&P 500, right, with Philip Morris, you can see that it doesn't have that growth compared to Amazon. But the reason why it does not have that growth is they are giving out the profit back to you, the investor, as a form of dividend. So each team has its own goods and bad, where we have gone through the pros and cons already. So when we come to investment, whether you want a lump sum investment or monthly GIRO, right? Most of the time, to be honest, it's not up to us. Personally, for me also, at this stage, I probably cannot afford a lump sum investment. So most of my investment are in a monthly GIRO format also. And don't be turned off by it, because monthly GIRO is actually good, because it is great for investors who do not have large capital. It retains your cash flow for other commitment while you are still able to invest. So especially if you have a mortgage to pay, or you have commitment for your kids, you are saving up for their education, right? You are able to retain your cash flow by using monthly GIRO. And there is a dollar cost averaging effect, and it promotes disciplined saving. And lastly, right, the most advantageous is passive. There's no effort required. If you are trying to do a lump sum investment, right, you get blur on, okay, when should I put in this lump sum, and sometimes it can affect you. So the best is like just monthly GIRO. Everything is passive already. So in this section, I'm going to go through investment strategy by profile. So think of the 2 unit trust team that I mentioned and the investment profile that I mentioned earlier. So the first group of the profile, the student, young working adults, right? As mentioned earlier, not much capital, but able to take on a lot of risk, and they have a lot of time on their hand. So the age group is probably 18 to 30 years. Also, if you are within this age group, right, do take note of some of the points here. And you probably do not have mortgage or family commitment. That's why you are able to take on more risk. And you don't need the passive income because you are working. You don't need that $500-600 every year from all your dividend unit trust. Just go and work some overtime. You got the energy. Okay. So what we will recommend is, suppose you have this amount of cash for investment, right? We suggest that 70% of it you can dedicate to growth unit trust, and the other 20% you can dedicate to dividend and defensive unit trust. And the remaining 10%, right, it can be a wild card, like it can be whatever you want to do. So it still gives you a certain level of freedom for you to choose, or whether you favor defensive or you favor growth, you can make use with this wild card. So the suggested investing method is, of course, a monthly discipline GIRO into unit trust. And let's say, for example, you earn a monthly income of $4,000, right? You can maybe invest about $1,500, or if more, even better. And this, whatever amount that you are able to invest, right, you can allocate them into these specific percentages. So in this case, right, maybe you can have $1,050 into growth, then you can have about $300 into defensive and dividend unit trust, And the other 10%, right, because 10% is very little to take on a monthly basis, I just lump it together to be a yearly lah. So in 1 year, you probably have 1,008. So this 1,008, right, you can do whatever you want. So it does give you some level of freedom. Maybe you want you go and like see Facebook or all the GameStop and Tesla stuff going on. You might want to try. You can go for it. Mainly because even if you lose a bit of this 1,008, right, it is not like your entire portfolio lah. So that is where you can afford to take risk. Or maybe you want to invest in a unit trust that is in emerging market you don't really know, like Indonesia, Thailand, or you might even want to invest in Bitcoin, so you can do whatever you want with this 1,008. Or maybe if you want to be safe, right, you can just put it in a growth or defensive unit trust, also up to you lah. So the second group is married and or working parents. So this is like the more of I will say in the middle lah. You have a bit of time, a bit of capital, a bit of risk, but not so extreme as the other two. So you are probably around 30 to 55 years old. You have mortgage and family commitment, not able to take as much risk ready due to all the commitment, and maybe a small passive income may be beneficial to reward yourself. So like maybe at the end of the year you get like $600 dividend, right? You might want to go for a staycation or what. It is like good for you in terms of mentally like reward yourself from your investing. So what the kind of allocation that we will suggest is you probably need to tone down a bit on the growth ready because you do not have that level of risk, and you might want to put more into defensive and dividend. And still, we will suggest that 10% in your wildcard. So let's say by this time, you probably have sufficient number of years in your working environment, you have promoted, your salary is maybe around 6,000, but due to your mortgage and your family or what, right, you probably could not afford so much of this 6,000 for investment. So let's say you can afford $2,000. So these numbers are very modest amount. It's not out of reach for a lot of people. So it can be like 1,000 per month for growth, and then $800 per month for defensive and dividend, and maybe 2,400 for your wildcard, or you can do whatever you want with it, as mentioned earlier. And lastly, right, a retiree or near retiree. So these are very special groups because maybe you are above 55 already, the CPF money want to come out already, so you want to get ready lah. Okay, so lots of cash, no longer have mortgage, you no longer have family commitment, or your kids all like fly ready lah. Kids have grown up. And your important thing is you are no longer in the workforce, meaning you do not have that luxury of monthly income ready. Hence, you cannot take on so much risk with whatever capital that you have lah, even though you might have a lot. And you need to rely heavily on passive income. And if your passive income is able to maintain your lifestyle, right, this is of course the best case scenario lah. And I'm not including any CPF as well. So this is outside of your CPF lah. So because of the fact that you are no longer in the workforce and you need to rely on passive income, right? You want majority of your portfolio into dividend and defensive. And remember what I mentioned about dividend and defensive earlier. It is good that you have a lot of capital on hand to reap the benefit of the yearly dividend. And retiree or near retiree, they probably have that kind of capital lah. So the other 20%, you want to remain in cash because you want to remain solvent in case something urgent happen. So suggested investing method is lump sum into dividend and defensive unit trust. Suppose you have $1 million in saving by the age of you retire, right? What you will notice is that 600K, 60% into a unit trust, or maybe anything that gives you 4% dividend yield, right? It equates to a passive income of $2,000 per month. So I'm using 4% as a benchmark. This is mainly because we are looking at CPF passive yield, your special account. And the 20% in cash, right? You do need it as form of liquidity and rainy day funds, because let's say your dividend only comes in at the end of December, right? Then what money are you going to spend until that money comes in? So you need that cash to tide you through lah. But still, we do not want to forego growth altogether. Maybe you still want that 20% in growth, because some of the growth company, right, they can grow a lot in 10 years and 20 years, and you can still afford that amount of time, and you don't just want to give up this portion also. But of course, we do not want to be taking so much risk in the growth, so we only allocate 20%. So this 20K, right, you can just put it in your growth unit trust. So in summary, right, from the age of 20, from the early stage, your goal is to focus on growth because you have that ability to take the risk. And as you grow older and older to the age of retiree, right, things become reverse. You want to focus on dividend and cash. And you will see that your growth and risk get lower and lower, and your dividend and cash will get higher and higher. So this is like just a summary so that you can remember easily. So what you will notice is that most of your unit trust plan and tenors, right, they tend to be 10 to 15 years long. And if you start from an investment age of 20 or maybe even 25 like that, right, when your first unit trust mature, it probably just nice you are into your second phase of your life already, where you get your first house, you start to marry, and that capital that comes from your first unit trust mature, right, it can propel your second stage of your life and can push your second level of investment into even a higher growth in the sense that now you have a pile of cash sitting to help you invest some more. So there is a compounding element there that is helping you. And just nice, the unit trust that you invest when you are at 35, right, it is going to mature sometime around age 50 when you are about to retire. And just nice, at that period of time, you need that large amount of capital to invest in dividend and cash. So everything is working like in a very synergetic manner. So after unit trust tenor end, right, you have sorry for the grammar, you have cash available to fund your next phase. Okay, so that's roughly about how you should plan your investment based on your profile. So next, we are going to look at trends and market outlook. So in this section, right, we are going to cover our opinion on what are the up and coming companies that we should look at and how we justify their performance and what are the trends to look out for. So you can kind of like think of it as our recommendation. And you should look out for unit trusts that contain all these companies. So what we are looking at is mega trends. Mega trends are powerful, transformative, very disruptive force that could change the global economy, business, and society. So if we look at past mega trends, right, we have things like smartphone, digital camera, and of course the internet, where our way of life is largely affected by all these innovations. So when we want to look at future mega trends, these are some of the things that we can identify. So in the first category, we have esports. So for those who are a big fan of Dota 2, right, you will realize that year after year, the yearly international prize money, right, it has grown over to million, and it's like nowadays, those 18, 20 years old kids are earning million from winning this kind of tournament. So the key thing is the demand is there. The demand is there. So the next one is online digital and crypto payment system. So these are all your Visa, MasterCard, and the touchless payment system, and self-driving automobile, targeted digital advertising. So your Facebook ad, Google ad, augmented reality and the metaverse, and lastly, the cloud computing services. So when we want to invest, we want to look at companies that are able to contribute to one or more of these future mega trends. The more, the better. So these are some of the companies that we kind of like handpick that have exposure to one or more of these mega trends, but we will look at details on some of these companies. So first, we are going to look at Microsoft. It is one of the very well-known company in the world. And when we look at and justify the performance of company, right, we will roughly teach you how to look at them. But do note that this is a very crash course, basic surface level kind of analysis. And of course, in order to put your money into a company like this, right, maybe you need a much, I would say, more in-depth analysis, but just for the purpose of this presentation, right, we are going to go through some surface level matrix that we use to justify our pick for companies like this. So the first thing we look at is year-over-year increase in revenue. So on your left-hand side, you see the financial performance, right? What we want to see is this company have the revenue is higher than the previous year. It should be always going up, because increase in revenue represent that the people have demand for your product and services, and it is good that you are growing year over year. If at one point you start to go downtrend, right, maybe you are out of the market already, there is some better competitor coming out, so you need to be a little bit more careful. But as long as this is in an uptrend, right, you are fine as a company. And the next one, so for Microsoft, we can see that increasement in year-over-year revenue. So the next one is year-over-year increase in profit. So exception apply. I will go through slightly more in detail later. Profit is the orange color bar. You can see that it is increasing also. So this is the tick. And year-over-year increase in net margin, or at least it is maintained. So net margin is referring to how much money is retained from the profit earned after all your operation costs. And it is good that the level is at least maintained. And for Microsoft, right, it is doing quite all right. And even for 2021, it increased by quite a bit. And the PE ratio, so PE ratio is a slightly technical term, but in summary, right, what you need to know about PE ratio is it is a comparative ratio of how overvalue or undervalue a company is by comparing the share price and their earning. So if it is a high value, right, it means that this company is overpriced, meaning that the share price is very high, they are not earning so much, while they are not earning so much. But it also doesn't mean that low value is good, because a very low PE ratio value also means that there is something intrinsically wrong with this company that no one wants to invest in them. So like what you want is, in summary, right, what you want is you want to be somewhere in the middle. You want to be aligned with the industry average. So under PE ratio, right, we are going to compare the company PE ratio. So for Microsoft is 37.7 to the US tech sector PE average, which is 31.1, and it is somewhere around there, So this is okay also. And lastly, we want to see if a company have the skin in the game. Is it part of the mega trend movement? And yes, it is. Microsoft is involved in augmented reality, e-sport, and cloud computing. So what you will notice is that in the US market or in the world, right, there are like thousands and thousands of companies out there. And for a company to be able to meet all these checklists, right, it's not so easy to find. It's not so simple. So in the further slide, right, you will see some of the companies that we mentioned might miss some of the points, right? But it is still okay, because we are investing into unit trust. And the advantage of unit trust is that it helps you diversify, really, meaning you don't really have a huge stake in one company that missed some of the points that we have mentioned. And one company that we want to go through is Tesla. So I think this is very famous, our dear Elon Musk. So year-over-year revenue, yes, you can see the green color, but when we come to profit, right, it's a big question mark, because Tesla is only profitable in year 2020. Back in 2019, 2018, right, it's not so profitable. In fact, it's making a loss. But if we can find why Tesla is making a loss, because it is focusing on growth, opening of a lot of these mega factories, right? That's why they are in a loss. And that kind of loss is okay, because it shows that they are focusing on growth. So this one, it requires a little bit more in-depth analysis, but we will not go through that in detail here. Okay. So year-over-year net margin also increasing. And the PE ratio, right, you can see this one, the PE ratio is at 11,000, whereas the industry average is 31. So this one definitely no. But the skin in the game is self-driving automobile and augmented reality. So you can see that Tesla missed a few points. And in this case, right, I can say that Tesla a little bit speculative in nature. Maybe you want to buy, but not so much. And once again, I want to emphasize the importance of unit trust, because if you buy unit trust that have Tesla, you don't really need to care about all this really, because everything is diversified for you already. So even if Tesla underperform, right, it probably like take maybe 1 or 2% of your entire portfolio of the unit trust that you don't need to worry so much, but you still have exposure to it. So these are other companies I won't go through in details already. So we have Visa and MasterCard, the net margin, okay. Then PE ratio, both okay, and they are involved in digital crypto payment. Alibaba, Amazon, net margin, a bit this one, Alibaba, don't know. We won't go through so much in detail because Alibaba a little bit special, all the China regulation stuff. Amazon net margin quite okay. PE maybe Amazon slightly overpriced and they are involved in digital payment, targeted advertising, cloud computing, all this. And Google, of course, one of the better company out there. Everything you will see is quite okay, all green tick. And TSMC, the Taiwan Semiconductor, does look okay for everything also. And Apple, our favorite, everything's look okay. Salesforce, PE definitely no, it's slightly high, but once again, right, if you are looking out for unit trust, this kind of missing a bit here and there is fine, but you don't want to miss everything. And the most important factor that we want, most important checklist that we want to meet is the revenue checklist. Cloud computing. Okay, so if we look at the kind of unit trust available in the market, right, like for example, you see this particular unit trust, you can see that the top 10 holding, we have Microsoft, Apple, Alphabet, Facebook, Salesforce, Visa. So these are the kind of unit trust that you want to look out for. This is another example, top 10 holding, Amazon, Microsoft, Apple, MasterCard. So in summary, right, unit trust allow you to invest in all the mentioned company at an affordable cost with minimal transaction fee and a disciplined saving plan with a monthly GIRO payment, right? It will make your investing journey seems effortless and you will see great result the moment your unit trust mature. Okay, so our next session, because when we talk about unit trust and investing, right, all these are very passive. You just choose a unit trust, set up a monthly payment, and then that's it really. You just sit and wait. But what if you want to do something actively? Is there something that you can actively do while your passive is ongoing by itself? And that is where Nimbus Capital will come in, because this is where we specialize at, and that is active trading. So maybe you have all these fund in your unit trust investment, right? Let's say 70% of them. Actually, the other 30%, right, you can explore active trading if that is something that you are interested in. So what is active trading? It is buying a stock and holding it for a midterm, about 2 to 6 months, compared to, let's say, a unit trust, which is like 10 years. And it is to capitalize on the current explosive trend. And it requires discipline, recognizing trend, and a good level of risk management, because now you need to manage all this by yourself already. And it carries a higher risk compared to passive investment. So it's not for everybody, and it also has a higher learning curve. And in return, right, if you perform properly, it can generate quite a significant returns. And remember when we mentioned wildcard, right? This wildcard, you can actually use it to save up for a trading account also, like your 30% of your portfolio. So I'll go through some of the explosive trend that I mentioned earlier. So during early 2020, when COVID first started, right, what is the one trend that you see is property price going up? But before they went up, right, there were a lot of rumors that like property will crash. A lot of my friends waiting for fire sale, but in fact the opposite happened. So what happened was all the HDB price and the private condo price shoots up, and in fact if you want to get a BTO now, right, it's actually very, very hard. So while all these property prices are going up, how can we benefit from such a trend? And you will notice that on Singapore market, Propnex is a listed counter, and during that period from 2020 until now, Propnex went up 259%. And compare that to Amazon, it is like common saying that Singapore market is dead, blah, blah, blah. But these are some of the trends that we are able to identify and take advantage of. Okay, so aside from that, we also have things like MedTech International, which specialize in hospital consumables. We also have the glove maker. This one definitely, I think everyone will know, even if you are not in the investing circle. Of course, the most famous one, Sheng Siong. When Sheng Siong news came out, say the employee get don't know how many months of bonus, a lot of my friends like, hey, you want to go work for Sheng Siong or not? So similarly, all these counters, they are all listed in Singapore market. Sheng Siong went up 57%. Top Glove went up 369% within that period. So as a short-term trader, as active trader, right, these are the kind of explosive moves that we want to capitalize on. And in fact, right, this kind of trading, it can also complement your passive unit trust investment also, because what you can do is that if you successfully manage to catch such an explosive trend, right, all the profit that you make from your trading, you can pump it into your unit trust investment. And what you are doing is you are actually converting high risk, unpredictable income, because you never know whether the trend that you are trying to catch is able to go up or not. And you are converting all these income into a low risk product. And this process is called portfolio rebalancing lah. And by doing this, right, you are generating additional compounding effect on top of the compounding effect that your unit trust already have. So you have like a super compounding effect, and it can catapult your portfolio to your retirement age with very, very limited risk. And if you want to compare, right, between no compounding, normal compounding, and super compounding, you can see the time it takes to reach a certain milestone is reduced drastically. So for example, let's say you want to hit 2 million, super compounding might take you 30 years. A normal compounding might take you 50 years. But if you don't compound, right, you'll take like 170 years. So you're probably saving for your grandchildren. For our company, right, Nimbus Capital, these are some of the services that we provide should you be interested. And one of our service is subscription-based service. So it's a $20 USD, $20 per month with GST lah. So this one is the platform rule. I can't avoid it. So what we do is we provide a lot of bite-sized information like weekly webinar. We provide market update and outlook, potential trends and companies for trading. I also go through our Nimbus Capital portfolio and what we are trading in. We have in-depth video analysis. We have trade ideas and trade plans that we share. And we also provide a statistical data of all the trade and investment that we have done. So you can see how they are performing. And we also have AMA sessions. So if you want to know more about us, we provide such a session also. And our second service is we also have a 3-month course, which we provide all the educational and the information necessary for you to become an active trader. We go through mindset adjustment to mentally prepare you to become an active trader, risk management, and trading theory, strategy, and portfolio management. Of course, we also have a YouTube channel, which everything up there is available for free. You can go to YouTube and go and search Nimbus Capital, the trading channel, right? You can see some of our analysis and video. So you will hear my voice a lot here. So a fair warning. So I have come to the end of my presentation, and I'll give you guys about 10 seconds to maybe screenshot this, because you can find us on Facebook, and this is the subscription service that I mentioned just now, and this is our 3-month course if you are interested in knowing more. Okay, so at the meantime, right, I will pass back to Alvin. Thank you for the opportunity.
Thank you so much for sharing, Zawu. Before we continue further, if let's say you guys have any questions for him or for us, feel free to actually jot it down in the chat box. Then I think either Zawu, me, or Shane will actually help to assist with the questions. Yeah, be it for Nimbus or for Potential as well. Yeah. So while we are waiting for any questions, right, I actually just want to maybe share with Zawu my personal impression, because just now actually when he first shared with me, right, actually I was very impressed, because I feel that the way he shared is very simple to understand. I think all of you actually can see that he is able to mix seemingly difficult, complicated topics, right, into very simple concepts. That I think is actually very rare in the investment industry. Yeah. And one thing I feel that Zawu is also very good at is the services he provides actually far exceeds just normal investment planning and teaching. He's also able to actually share with his clients several different disciplines throughout different stages. So whichever life stages you might in, like as he mentioned just now, be it you might be a student or fresh grad, or maybe mid-30s or planning for early retirement already, okay, it's always he will still be able to actually benefit you through his service, which I think is very impressive. Yeah, so thanks again for sharing, Zawu.
Thank you.
Yeah, okay, so let me I think we have one question by Anonymous. So what is the time horizon that I should be looking at for growth unit trust? Is the question Zawu, would you like to take this question for growth unit trust specifically?
Okay, yeah, sure. So normally for growth unit trust, what we mentioned is that you need time for this company to grow, and the time horizon, right, is it differs from companies to company, but if you are investing in a unit trust which comprise of many growth company, right, the appropriate amount of time horizon, I would say about 10 to 15 years, which is usually coincide with the tenure for your unit trust products out there. And this number, right, we are looking at past growth company that is able to become the kind of giant that we see today, such as Amazon, Apple, or even other other companies such as Microsoft, right? They did take about 10 to 15 years to become as prominent as they are right now.
Thank you so much, Saul. So is there any other questions? Yeah. This one free one, the Q&A session, yeah.
Yeah.
You guys are wondering.
Yeah, feel free to ask. If it is within my knowledge to answer, I will definitely answer.
I think partly is also because your sharing is very good already. Like you really managed to cover. I'm serious, really, to cover all the grounds that actually any potential question that they had is already answered already. Yeah.
Okay.
Because even for us, to be very honest, even for us consultants, right? Actually, just now we were speaking after a dry run. Even for us, in having so many years in the industry, we still managed to learn a lot of things from your slides. Yeah, so you were still very open to actually share with us a lot of things. So I think a lot of them actually also learn a lot. Yeah.
Okay.
Okay. So okay, I think for now we don't have any questions coming in first. With that said, yeah, so actually if any one of you are interested in attending Zhao's Nimbus Capital Solutions courses, feel free to actually ask your consultant for the contact as well. If let's say this is your first intro into this kind of industry or climate, right? Okay, I think having a coach, having a investment coach is really a very good advantage. Yeah. So once again, thank you so much to Zhao. I will invite you to, I'll let you take a break first. Yeah.
Any unit trust.
Yeah.
Okay, so as I went through in my presentation just now, right? Any unit trust with those company that I have mentioned are actually good. And in fact, the two examples that I shared, they are part of, I believe, what Prudential is providing also. So you can approach like Alvin to see, okay, what are the unit trusts with all these company, and he will definitely able to share with you.
Thank you so much. Sorry, right before you make a move, right? I think the one last question just came in.
Okay.
So yeah, so any unit trust is are you yourself buying or would recommend to buy in?
Okay, so the unit trust that I'm personally buying is a unit trust that has all the S&P 500 So anything is directly related to S&P 500. So there can be a lot of US tech unit trusts out there, but most of them, right, they are somewhat the same. They have all the same Microsoft, Apple, Amazon, all these. So even though there are maybe 10, 20 different US tech, right, most of them have similar performance. So as long as I can see all these big major companies that we have mentioned, right, it is actually quite fine. You don't need to go into that specific which unit trust, because sometimes the unit trust is handled by different manager, different firms. So maybe that same team, right, it can come up like 10 different 20 different unit trust. So I don't think you need to go into that specific level of which unit trust, but rather the team itself, as long as you are within that team, right, is fine really.
Okay, thank you so much for your time. Okay, then without further ado, let you take your leave first. Yeah.
Okay, thank you.